Now, what do we often say to you? We often say, okay, so assuming, we're here, we have this, right? Let's just say, we've seen price action has sort of tested this region once, comes back, does another test, stuff like this, right? There, okay. So you're saying, okay, I'm going to look to sort of, I don't know, let's say we've had some sort of pattern be formed here like that. You're waiting for the break of this trend line here, this convergence of price action, waiting for a bullish trend. Okay, so you enter there. That's your entry. Yeah, and then you say, okay, I'm going to define my stop loss. I'm going to place my stop loss below this support line. I'll place my stop loss below this support line and away from sort of the current swing. So sort of in this region here. That seems rather safe, right? Because the key question to ask yourself when defining a stop loss is, at what point would it define that it's no longer a trade idea for me, right? In other words, let's flip that question. At what point would you decide to go short is where your stop loss should be for a long position, right? And when you've got a short position, at what point would you go long is where your stop loss should be, right? So, I would only sort of look to go short if price action breaks through this key level support. So that's where my stop loss should be, right? So I've defined my stop loss, defined my entry, and then I've said I take profit. Let's just say I've said I take profit. I'm just going to go with sort of below the next level of resistance. Let's say this is that next level of resistance, okay? That's our next level of resistance. I'm going to take my profit within the resistance. We don't want our take profit to be taken at resistance or above resistance. Above resistance is just completely unrealistic. At the resistance, you're expecting sort of a perfect trade to occur, which may not always occur. So just have a realistic expectation. So I wouldn't even say there, it could be sort of anyway, sort of in this range here, right? Where you start to see a bit more selling pressure stepping in rather than at the resistance line. Okay, so let's just remove some of that, right? So TP somewhere in this region here, entry here, stop loss here. And, let's say we've had a fantastic trade. It's going in our favor. It's going like this. It's heading that way. But Jonathan, I think it was Jonathan, was it? Jonathan. Yes, Jonathan. I mean, if I'm here, if market price is here, this is market price. TP's there, right? It doesn't mean that I leave my stop loss here. Would you leave your stop loss here? Would you leave? The market right now is willing to give you this amount, this X amount, right? Right now, are you going to allow the market, instead of trying to at least reduce your risk or lock in a little bit of profit, allow the market, if it all of a sudden turns based on news, to do this and hit your stop loss? I think then it's just bad trading. It's bad trading. It's not that the market's not gone in your favor, right? The market at one point was willing to give you this amount, right? But at no point did you look to sort of, let me see how much I can lock in of this, right? So another way to put it is, now when you identify reward to risk ratio from your, from the outset, from the beginning of you taking the trade, so you'd say from here to there, to there to there. Yeah. So fantastic. Let's just say this is I don't know, let's go with a 5-to-1, right? A 5-to-1 setup. Okay, 5-to-1 setup. Yeah. But now price is here. This is where the market price is. So what's the reward to risk ratio from this point? Now, if my stop loss is there and my TP is there, so that means that's my take profit level and that's my stop loss, right? What does that look like? That may look like, I don't know, I'm losing more for what I'm looking to gain, right? Just that alone, I'm willing to give up more, because what you're doing here is you're not giving up. You've just not given up just this amount, right? You've just given up all of this amount as well. This is what the market is willing to give you. So, you must, do some form of in-trade management where you bring up your stop loss. I'm not saying being aggressive, be conservative, or, what you should do exactly, but you must trail your stop loss. You must trail your stop loss. Okay, so you move your stop loss to somewhere sort of in this region here. Yeah, so SL2. Okay, now in questioning sort of how do I trail my stop loss? Now let's go through that. So how do I trail my stop loss? So from this example, we can take a lot. Okay, what's the first step? What's the first thing that I'm going to notice, right, that will indicate that I should move my stop loss? Reward to risk ratio. Okay, sorry about my typing, but it's the best I can do. Yeah, reward to risk ratio. Reward to risk ratio. Well, it's not typing, it's really drawing, isn't it? Yeah, so once the reward to risk ratio starts to go against me, and I'm sort of, risking not just my initial risk, but I'm risking this amount because this is what I've, the market price is, currently. So I'm not just, let's assume, you're making 500 here, right? You're making 500. Your stop loss is 100 risk. Okay, so you're losing $100, you're making $500, right, in this trade. Market prices here, you've locked in 250, right? Well, you haven't locked in 250, sorry. You've actually, you currently the market is willing to give you 250. Yeah. So does that mean on this trade you've only risked $100? No, because where current market price is, you've risked $100 plus $250, so $350. Yeah, so you must incorporate where the current market price is and what the market is willing to give you as part of your own money in addition to the original risk that you're taking. Yeah, so that alone means, okay, I'm moving on stop loss, right? I've locked in, I don't know, $50. Okay, better than what it was before, right? Right. So now I've only got $200 at risk here, right? Current market price $250. Where my stop loss, I'm probably sort of willing to give back $200, but I'm looking to gain $250. Makes more reasonable sense mathematically, right? So that's the way you must think when it's, in moving your stop loss, right? So reward to risk ratio is the first key point, right? The second key point is when I do move my stop loss, I would want to move it for a technical reason, right? It needs to be a technical reason, okay? There needs to be some sort of, reason. I'm not just going to move my stop loss right behind price action over here because the chance of it just stopping me out here is extremely probable. It's extremely high. It's likely to hit my stop loss and then go maybe to my target. Then I'll be just kicking myself, right? Then I've just been far too aggressive, right? So you need to sort of be able to manage and move your trading stop loss for a technical reason. And that might be, based on, price action, sort of, a previous swing, right? So price action makes a new high, retraces, then makes a new high. That allows you to move the stop loss behind the swing. Again, retraces, makes a new high, and again, you can trade it behind the swing. So behind swings, behind your trend line. So if you have an uptrend line, that's not great, but you get the gist, sort of, an uptrend line like this, then you start trading it with the trend line, yeah, or moving averages as we just covered. Okay, so yeah, that's the second key point, is defining a technical reason. Again, there's no right or wrong. It's all about testing. You've got to test what's best for you, whether it's a conservative stop loss trading management or a more aggressive in-trade management. Yeah. Now, sort of the third key point I'd probably sort of highlight in moving your stop loss is vol, right? You've got to sort of consider the volatility in the market. Okay, you must consider the volatility in the market, right? Like we just saw in Ripple, right? Ripple, we saw sort of yesterday's moves just almost parabolic, and then what did it do after it sort of reached? I don't know. I think it's about where was it? 7.6 or something like that, just shy of 80 cents. It flatlined, literally flatlined back to sort of I don't know, where are we now? 36 or 30, somewhere in that region there. Okay, so if you was taking this trade, imagine you got in long hair, right? You've got in long hair, right? And it's going in your favor, okay? Somewhere in this region here. You're not going to be too conservative with your stop loss, right? So when you have a parabolic move like this and it just goes in your favor, you might want to sort of apply a aggressive stop loss, right? You might want to apply an aggressive stop loss to really maximize that parabolic move. Okay. Yes, it might just hit your stop loss and then go even more parabolic. Okay, there is the risk of that, but that's the risk in anything. I'd rather have made a little bit than made nothing, right? So when it comes to a very volatile movement, extremely parabolic move as we're seeing recently in market prices across a few assets taking place, right? So yeah, you want to apply a more aggressive and really try and lock in as much as that. Okay. Whereas if it's something that's a bit more conservative, a bit more sort of, going gradual, gradually climbing, then you can sort of, have more conservative, just trading it every so often, right? Not being too aggressive, maybe leaving a bit of buffer. Yeah. So yeah, do view the volatility in the asset that you're trading. Yeah. And I think those are the sort of 3 key points. Those are probably my 3 key points. Generally, defining reward to risk ratio, the technical sort of, reason, volatility. Yeah, it's just got to make sense in that way.